Trading is a lot like navigating a stormy sea. The potential for profit is always there, sparkling on the horizon, but the waves, those sudden, unpredictable moves in the market, can hit you harder than you ever imagined. And if you don't have the right safeguards in place, even one misjudged wave can sink your entire vessel. That's where stop-loss orders come into play. They are more than just a technical tool, they're the lifeline that allows you to trade with confidence, control your emotions, and preserve your capital. Today, I want to dive deep into the art and science of stop-losses and show you exactly how to wield them like a professional trader. I remember one of my earliest experiences with stop-losses. I was trading the euro to US dollar, and I had a strategy that, on paper, seemed flawless. I had done my homework, technical analysis, support and resistance levels, trend lines, everything checked out. I found a setup at 1.1, with what I believed to be a clear path to 1.12. Now, the novice trader in me wanted to just throw my money into the market and ride the trend, thinking, this is going to be easy. I see the move coming. But experience had taught me something crucial: markets are unpredictable. They test your patience, they exploit your overconfidence, and they will hit you when you least expect it. So I set a stop-loss at 1.095, just below a key support level. Why? Because I wanted a clear line between the risk I was willing to take and the market's chaos. That 50-pip buffer wasn't arbitrary, it was calculated based on volatility, historical swing points, and my risk tolerance. It was enough to let the trade breathe but tight enough to prevent catastrophic losses. And alongside that, I placed a trailing stop, initially the same 50 pips away from my entry. This would allow me to capture gains if the market moved in my favor while still protecting my downside. The market, as always, didn't follow a straight line. It moved sideways for hours, testing my patience. I found myself refreshing my charts every 5 minutes. Heart pounding a little faster each time the price dipped close to my stop. But here's the thing, the stop-loss removed the worst of the anxiety. I didn't have to make a split-second decision to bail out or stubbornly hold on and hope for a reversal. The market could do its worst, and I knew my maximum loss was defined. That peace of mind allowed me to stay focused on analyzing the market rather than reacting emotionally. Eventually, the market began its upward climb. My trailing stop started adjusting, creeping up with each increment the price moved in my favor. By the time euro to US dollar hit 1.11, my trailing stop had moved to 1.105, ensuring that, even if the market reversed abruptly, I would still secure a profit. Watching that happen was like seeing a safety net tighten just as the trapeze artist swung over the pit. By the time the price hit my target of 1.12, my trailing stop was at 1.115. I could have closed earlier, but the market kept moving favorably, and the structure of my stop-loss allowed me to stay in the trade and maximize my gains without risking a reversal. Now let's talk about why stop-losses work beyond just numbers on a screen. They enforce discipline. In my years of trading, I've watched so many traders, myself included, fall into the trap of hope, fear, and impulsive decisions. You'll see a position move against you and think, maybe it'll turn around, and before you know it, you've lost far more than you ever intended. A stop-loss forces you to predefine your risk. It's a commitment you make to yourself, and it removes the dangerous gray area where emotion and indecision thrive. Stop-losses also interact with your risk-reward ratio in critical ways. Every trade you take should have a defined potential reward relative to the risk you are taking. If you're risking 50 pips, you want to make sure your potential reward is at least 2, 3, maybe even 4 times that. By defining your maximum loss up front with a stop-loss, you can align your trade with a positive risk-reward structure. This is what separates professional traders from the hobbyists. Professionals don't chase random profits, they manage risk intelligently so that even a series of losses doesn't destroy their accounts. There's also a psychological benefit that can't be overstated. Knowing that your losses are capped allows you to stay calm under pressure. Your mind isn't consumed by panic every time the market dips. You can step back, analyze the charts, and make rational adjustments. Markets are inherently volatile. Even the best analysis won't guarantee a smooth ride, but if you have your risk controlled through stop losses, you can survive those inevitable drawdowns and be ready for the next opportunity. Now let's expand a bit on the types of stop losses and how I use them. The standard stop loss is simple. Once the price hits the level, the market sells, closing your position. But in volatile markets, you might want something more dynamic. That's where trailing stops come in. They adjust as the price moves in your favor, locking in gains without forcing you to micromanage the trade constantly. They're especially useful when the market trends strongly, letting you capture extended moves while maintaining protection. Stop limit orders, on the other hand, give you control over execution price but don't guarantee the trade will be filled in a flash-moving market. And guaranteed stop losses, while sometimes costly, provide absolute certainty in highly unpredictable markets. Understanding which to use, when, and how, is a skill that develops over time. Let's circle back to John, the Forex trader, and see the broader picture. He had a tendency early on to enter trades without predefined exits. Inevitably, the market would test him, and he'd exit too late, taking far bigger losses than necessary. When he implemented a rigorous stop-loss strategy, everything changed. He began entering trades with the maximum loss calculated, adjusting for volatility, and maintaining a favorable risk-reward ratio. Slowly, he stopped panicking when the market moved against him, because his framework protected him. And over months of disciplined trading, his consistency improved dramatically. The stop-loss didn't just protect his capital, it reshaped his trading psychology. One of the most powerful lessons from that period is that stop losses are not a sign of weakness, they are a sign of professionalism. Markets are unpredictable, news events can shake volatility in seconds, and even the best technical setups fail sometimes. A stop loss gives you the ability to accept that uncertainty and still operate confidently. It allows you to participate in the markets while protecting the most critical resource you have as a trader, your capital. And there's a subtle point I want to make here. Placing a stop loss isn't just about picking an arbitrary number. You need to consider market structure, support and resistance levels, recent volatility, and the typical behavior of the asset you're trading. For example, a 50-pip stop on a quiet pair might be enormous, while the same on a volatile currency could be insufficient. The stop loss must breathe with the market, not fight against it. This is where experience, observation, and patience come into play. You'll learn to read the market like a living organism, and your stops will become part of that reading. Over time, incorporating stop losses becomes second nature. They form the backbone of your risk management, influence your position sizing, and inform how aggressively or conservatively you approach trades. They interact with leverage, with your overall portfolio, and with the way you manage multiple trades simultaneously. When used correctly, stop losses allow you to survive losing streaks, ride winning trends, and develop a long-term trading career that's resilient to the chaos of the markets. So, when you think about stop losses, don't just see them as a technical requirement. See them as a comprehensive tool that protects your capital, reinforces discipline, supports your psychological well-being, and ensures that every trade you take is aligned with a rational, calculated strategy. The markets can be merciless, but with proper stop-loss management, you turn uncertainty into calculated risk, chaos into structured opportunity. And that, ultimately, is the hallmark of a professional trader.
Thank you for listening to the 101 Trading Tips in the Ultimate Trading Podcast, brought to you by bellsforex.com AudioWorks. We hope this episode gave you insights, perspective, and practical ideas to strengthen your trading mindset and improve your decision-making. Stay disciplined, keep learning, and remember, every trade is a step toward building your edge. If you found value in today's episode, don't forget to like, subscribe, and turn on notifications. Sharing the podcast with fellow traders helps us grow and bring even more free trading education to the community. Visit us anytime at bellsforex.com for resources, guides, and tools to support your trading journey. Until next time, trade smart, stay disciplined, and keep building your edge. Happy trading.